Imagine you and a few friends are standing in a room with a big whiteboard on the wall. On the board are drawings of lemonade stands. Not real lemonade. Just drawings. Someone says, "I own this lemonade stand," and someone else says, "I'll give you $5 for it." Another person overhears and says, "Wait, I'll give you $6." Suddenly, everyone agrees the drawing of the lemonade stand is worth $6. Nothing physical changed. The lemonade didn't get better. The weather didn't improve. All that changed was what people were willing to say out loud. That, in its simplest honest form, is the stock market. People often explain the stock market like it's a place where companies raise money so they can grow, innovate, and make the world better. That story isn't wrong. It's just incomplete. The stock market is not primarily a machine for helping companies. It's a machine for setting prices based on collective belief, fear, and expectation. The companies are almost secondary. To understand it, you have to start with why stocks exist at all. Imagine you want to build a very big lemonade business. One stand won't do it. You want 10, then 100. You need money. But instead of borrowing from a bank and promising to pay it back no matter what, you do something different. You slice your business into tiny pieces and sell them. Each slice is called a share. Whoever buys a slice now owns a tiny part of whatever happens next, good or bad. This arrangement changes incentives immediately. You, the founder, get cash today. The buyer gets a claim on tomorrow. Not a guarantee. A claim. If the lemonade business does well, the slice becomes more valuable. If it does poorly, the slice shrinks in value, sometimes to zero. Nobody promised safety. Everyone agreed to uncertainty. Now here's the part that often gets skipped. Once those slices exist, they don't need the company anymore to keep changing hands. People can trade them with each other endlessly. The company doesn't get new money every time the stock price moves. That money just flows between buyers and sellers. The market becomes its own ecosystem, loosely connected to the business that started it. At this point, the stock market stops being about lemonade and starts being about opinions. When you buy a stock, you are not buying the company as it is today. You are buying your guess about what other people will think the company is worth in the future. That future might be next year. It might be next week. It might be 10 minutes from now. The time horizon is flexible, and that flexibility is where things get strange. If everyone agreed to hold stocks for decades and only cared about how much lemonade was actually sold, the market would move slowly. But people don't agree. Some want to hold forever. Some want to sell by lunch. Some are guessing. Some are hedging. Some are scared. Some are bored. All of them are interacting in the same place. Prices move not because companies change, but because expectations do. A company can have a perfectly normal day. No new products. No disasters. No breakthroughs. And its stock price can still swing wildly because someone somewhere decided they were more nervous than they were yesterday. Or more optimistic. Or because a different investment suddenly looked more attractive, and money moved. This is where honesty matters. The stock market is not a scoreboard of how well companies are doing. It's a voting machine where votes are cast with money, and voters change their minds constantly. You might wonder why this system doesn't collapse under its own confusion. The answer is that confusion is not a bug. It's the fuel. Liquidity exists because people disagree. If everyone thought the same thing, there would be no trades. No movement. No market. But disagreement alone isn't enough. You also need incentives that reward speed, confidence, and sometimes recklessness. Professional investors are not paid for being correct in the long run. They are paid for not looking wrong in the short run. If everyone else is buying and you don't, and the price goes up, you look foolish even if you're right later. So you buy. Not because you believe, but because the system punishes patience. This creates a subtle pressure. Decisions become less about truth and more about timing. Less about value and more about momentum. Prices start reflecting what people think other people will think, rather than anything concrete. At this point, the market starts behaving like a crowd watching a parade through a narrow street. Everyone wants a good view. No one wants to be the last person standing behind a tall person. So people shift. A small movement becomes a push. A push becomes a surge. And suddenly the crowd is running, even though nothing actually happened. When prices rise quickly, people say the market is confident. When prices fall quickly, They say the market is scared. These are metaphors, but they're not entirely wrong. The market doesn't have emotions, but the people inside it do. And emotions become data once they affect decisions. This is why bad news can sometimes make prices go up, and good news can make them fall. What matters is not the news itself, but whether it was better or worse than what people had already imagined. Expectations are the real currency. Now let's talk about honesty again. The stock market does help companies raise money, but that mostly happens at the beginning, when shares are first sold. After that, the market mostly helps investors trade risk with each other. It's a giant, constantly updating agreement about who is willing to hold uncertainty and at what price. Risk doesn't disappear. It just moves. Some people are better equipped to hold it. Large institutions can wait out storms. Individuals often can't. This isn't because individuals are less intelligent. It's because their incentives are different. If you need money for rent, volatility is not an abstract concept. It's personal. The system doesn't care about that distinction. It treats every dollar the same. Over time, layers get added. Derivatives, index funds, algorithms. Each layer is designed to make something easier, faster, or more efficient for someone. But every layer also creates distance. Distance between decision and consequence. Distance between price and reality. This distance is why markets can feel unreal. Numbers move. Charts spike. Billions appear and disappear. And yet the actual businesses underneath often change slowly. A factory doesn't double its output because a stock price went up. A customer doesn't buy twice as much lemonade because a chart looks bullish. The market lives in the future. The company lives in the present. Sometimes the two line up beautifully. Sometimes they drift apart for years. When they drift too far, people call it a bubble. But bubbles are not caused by stupidity. They are caused by incentives that reward agreement over skepticism. If everyone around you is making money by believing the same thing, disbelief becomes expensive. Rational people stay in longer than they should, not because they're blind, but because exiting early has a cost. Eventually, something forces a reset. Not necessarily a catastrophe. Sometimes just time. Sometimes boredom. Sometimes a slow realization that expectations ran ahead of reality. Prices adjust. Stories change. Confidence evaporates. And afterward, people say it was obvious. It never is at the time. The stock market is often described as a place where money grows. That's another half-truth. Money doesn't grow there. Claims on future money do. And those claims are only worth what someone else will pay for them. Growth is not guaranteed. Loss is not accidental. Both are features of a system built on uncertainty. For a 5-year-old explanation, this might sound complicated. But the core idea is simple. The stock market is a place where people trade guesses about the future, using money as a way to keep score. The rules reward participation, punish hesitation, and amplify emotion. It works remarkably well at creating prices. It works poorly at creating certainty. And that's the part most explanations avoid. The market is not fair, but it is consistent. It doesn't promise safety. It doesn't promise justice. It doesn't promise that effort will be rewarded. It only promises that prices will move in response to what people collectively believe, fear, or expect next. If you remember that, the noise becomes easier to tolerate. Not because it disappears, but because it makes sense. The market isn't a teacher. It's a mirror. And what it reflects is not how the world is, but how unsure people are about what comes next.